2018 was a tough year for most global investors. After hitting record highs in the early part of the year, market sentiment started swaying as investors became concerned about slowing global growth, rising interest rates, trade barriers, and high valuations. Then in the last quarter of 2018, some panic started setting in, which resulted in global markets dropping 14% over the last 3 months. The panic that we saw in the last quarter was mostly exacerbated by worries about Chinese slowdowns and pretty sharp increases to US interest rates. Now, that saw the MSCI World Index declining 8.2% over the year and global emerging markets declining 14.5%. So in South Africa, the initial euphoria around the new president started fading throughout the year as the economic realities of slow growth set in. That was coupled with a general aversion towards emerging markets. Also, 2018 went down as the worst year in the JSE All Shares history since the global financial crisis, where the index declined 9% in Rand terms. The Rand, which actually rallied earlier in the year to 11 Rand 50 to the dollar, ended the year at 14 Rand 35 to the greenback, which ultimately meant that US dollar investors experienced a decline of 21% for the year. We view South Africa to be a standout opportunity currently. If we look at rolling 5-year returns in the local market, they've only been worse on 4 occasions over the last 40 years. And what we've seen subsequently, in the subsequent 3 years following these poor periods, in history we've seen 24% annualized returns from these low levels. Also, what's quite encouraging is that starting yields in both fixed income markets and equity markets are very high. If you're looking at the 20-year South African government bond, that's currently yielding close to 10%, and also the domestically facing companies in our portfolio are trading at 8 to 9 times earnings, which generally sets us up for strong returns going forward. Contrary to South Africa, which we think is a standout opportunity, globally, market valuations aren't yet at levels we think are very attractive. There are, however, pockets in global markets where a lot of fear and uncertainty has taken over and almost become pervasive, which has given us opportunities in parts of the market that are almost as cheap as they are in the midst of deep bear markets. Those tend to, however, be in more cyclical parts of the market where ultimately low expectations has given rise to good opportunities where we can buy companies, and actually good quality companies, at very low valuation levels. To give you some examples, companies we've bought over the last year: UK domestic companies, Japanese financials, the US real estate market, and more recently in global beverages. We've said for some time that we've been avoiding the high-quality defensive names where valuation levels have been extremely elevated for quite some time. These include areas such as the popular technology names, healthcare, and staple names. We also don't think that global bonds are offering value at this point in the cycle, and we aren't invested in that space. So in light of rising markets in 2017 and early 2018, we've been reducing our equity exposure for some time, which ultimately resulted in our cash levels sitting at record highs in January of 2018. Now, as markets and valuations came down over the year, and in the fourth quarter specifically, we aggressively increased our exposure to equities during the sell-off. We ended 2018 with 80% of the fund in equities, so we've currently got 20% in cash, which still provides plenty of firepower as either more market uncertainty comes our way or as we continue to find good opportunities. What is quite promising to us is, now obviously we've seen this recent drawdown in the market, is the valuations in our portfolio is now the cheapest since the fund's inception. Equities in the fund were trading at 10 times price to earnings at the end of December, and also the price to intrinsic value was trading at 60% of intrinsic value, which has been the widest in the fund's history. So from these starting valuations, we do expect good returns going forward.